Corporate finance practice problem using OneNote. Acquisition uneven returns problem number 2. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 2014 Acquisition Uneven Returns Prob 2 tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at an acquisition type of situation. One company thinking about acquiring another company and thinking about it in terms of basically a capital budgeting type of decision, in that we want to take a look at the cash flows that will be resulting from the transaction and see whether or not it is worth the time for the investment in a similar way as we might do if investing in something like equipment that would be having an impact for multiple periods in the future. Given the fact that it's a long-term type investment, we need to be taking into consideration time value of money. Typical tools will be the net present value calculation and the internal rate of return. If you want to take a look at more problems related to capital budgeting, we do have a practice section on that, so you can spend a bunch of time on that, where we do these types of calculations more. And also, if you want to take a look at the present value type of calculations, we have a section on that where we focus in on those calculations in terms of Excel worksheets and as well as mathematical problems and tables. So we're going to be considering the purchase of a company, one company considering the purchase of another. It's going to have an initial outflow of $3,450,000. And that's going to be at period 0. That's what the outflow would be, similar to like a capital budgeting decision where you have the outflow of like a purchase of equipment. And then we're going to have the inflows that we're going to say are expected from the purchase, from the company that would be being purchased, to see whether or not those inflows are worth the outflow that we're putting out up front. We're going to say for years 1 through 5, we got the inflow of $410,000 plus other benefits. Those other benefits not coming from the new company, we're going to imagine, but through increased production in our company due to us being connected together. We can call them synergistic, basically, increases. Then on 6 through 15, we're going to have another cash flow of $476,000 from the new company and $52,000 other benefits, synergistic benefits. And then years 16 through 27, $505,000 and $73,000 of other benefits. Now we want to discount these using the discount rate of the 14%, which we can call the cost of capital. You might hear it called rate of return, the hurdle rate. And we're going to use a net present value calculation, discounting these payments back using that 14%. And that includes our rate of return in it. Therefore, if our net present value calculation is 0 or above, that means we cleared the 14% and may then keep the project. If it's below that, that means we didn't clear the 14%. So a couple of ways we can do this. Now the next question is, well, how am I going to set this thing up? You'll see that we have like multiple years that have the same payments in them. Whenever you see that, you're thinking present value calculations, you probably should start thinking, well, annuity. I could do an annuity calculation there. And that's true. You could do annuity calculations for these groupings since we assume the same cash flow for them. But it's a little bit more tricky because these second two, you'd still have to then do a present value of 1 to get them back to period 0. So we could do an annuity calculation for this one, an annuity calculation for years 6 through 15, but then we'd have to take it from year 5 basically back to year 0. Present value of 1 calculation. We could do an annuity calculation for years 16 through 27, but then we would also have to do a calculation bringing it back 15 years after that, back to period 0. So we will do that, and we'll see the other method, which you could just say, and this would be easy to do in something like Excel, because you could just copy the formula down. Say, I'm just going to do all years, which would be 1 through 27, present value of 1, all of them. And once again, that is not difficult to do in Excel, but would be difficult to do if in like a test question type of situation. So if you were in a test, you'd probably do the annuity type of thing. If you were working in practice or on a practice problem, you could do the present value of 1 type of calculation, which could be useful to do. And then you would want to think about it in terms of presentation purposes. Obviously, 27 periods can be a little bit overwhelming to look at. You could then group them in different groupings if you want, or the annuity calculation would also group them that might in a way that might be easier to see. Okay, so let's do this. We're going to do it the first way. I'm going to do it just 1 through 27 present value of 1 calculations, and then we'll go back into it and do it with the annuity calculations. So if we were to do this, we would just pick up, I'm just going to pick up 27 years. Now, once again, this would be a lot easier to do, and we do it in Excel. If you want to take a look at how to do it in Excel, it would be more difficult to do this type of method by hand. Then we're going to say that we're going to have the amount that will be in year 1. So year 1, we're expecting to get, let's pull over the trusty calculator because the calculator's staring at me. His calculator's like, I want to do something. So I'm going to pull up the 410,000 from years 1 through 5, plus the 41,000 of the synergistic gains. That's going to be the 451,000. That 451,000 here, then, we're going to apply the present value calculation, which I'm just going to look at in terms of Excel. We do this in Excel if you want to look at it that way. You can also do it in tables with a financial calculator or with a mathematical formula. We're not going to do those things here, but if you want to look at some of those more, take a look at a prior section where we do focus in on present value calculations. So the present value then, discounting that 14% back 1 year would look something like this in an Excel formula. Present value of the rate, which would be that 14%, which is in cell B10. Note, we made it absolute references in Excel, $ before the B and 10, because when I copy it down, due to the 14% being outside the table, we want to not move that cell down. That's what the $signs are doing. Then comma, the payment that we have, the number of payments that we have is going to be then this this 1 here. Sorry, this 1 is going to be the number of payments because it's 1 year out. Notice we did not hard code the number 1, but rather put it in the formula so that when we copy that down, it will move down to 2. That's why this table is quite useful. Comma. Then we're going to not have the present value or the payment amount because this is not an annuity but present value of 1. So we have 2 commas to get to the future value, which then would finally be that 451, result being present value of 395,614. Then the second one, because there's 5 years of the same amount of the 451, we discount that back at 14% 2 years back. That would give us 347.30. The formula for that would be present value of the rate, which once again would be 14%. Note it's the same cell with the absolute reference. That's what the $signs are doing, picking up that same cell in the table, comma. Number of periods is now 2, which then this one moved down. We did not hard code it or simply type in 2, in other words, but move the formula down, comma, payment, no payment. That's why there's 2 commas. And then the future value would be the 451. And that would give us our result of the 347.30. If we continue this process down, we got 3 more years here. We're going to say, all right, the 451,000 discounted 14%, 3 years out would be 304, 412. 4 years out, the 451 discounted at 14% for 4 years, 267.28. And the 451 discounted at 14% 5 years would be the 234, 235. Then we're on a different number down here. So obviously the present values are going down as they're going to be further out into the future because of the present value. Then we're now on the second tier, which we could pull up the trusty calculator. We got the 476,000 plus the 52,000. That's going to give us our 528. Discounting that back at the 14%, 6 years out gives us the 240,550. If we discount 7 years out, the 528, we're going to get the 211,009, and so on and so forth until we get down here to where we at now, where this thing's changed. Year 16 down here, year 16, that's when we have this change of the 505 plus the 773,000, which is going to give us the 578,000 discounted at 14%, would for 16 years would give us the 7131. This 578 discounted at 14% for 17 years. The last one was 16 years. That'll give us the 62,308. and so on and so forth. And then if we were to sum this up, this column over here represents the total payments without present valuing, $14,471,000, which is much greater than, of course, the cost that we would be putting down in period 1. But obviously, it's 27 years out. We do need to discount it. So if we discount it, we're at the $3,437,064, still greater than the $3,400,000. Actually, it's smaller than the $3,437,000. So you would think then that we would be under the 14% hurdle rate that we want to require. But we'll talk more about that in a second. For now, let's go back to the second way we can calculate this now. So we could do this using our annuity type of formulas as opposed to the present value of 1. So we have a nice little smaller table here, although it's kind of tricky. Smaller table, but a little bit more tricky. So we're going to say first we got that years 1 through 5. The amount for the years 1 through 5 is the 410 plus the 41 or the 451. Now we're going to do an annuity calculation for that entire 5-year period. And that would look something like this. We'd have equals the present value of the rate, 14%, comma, the number of periods is 5. It is hard-coded this time, given the fact that it is an annuity calculation. We're going to expect 5 years of a payment of $1,548,320 in the future. And then comma, the payment then is going to be the amount of, the payment is not the $1,548,000. The payment is $451,000, and we expect to have 5 of those. And then if we present value that, we would get the $1,548,320. Now this one is the first 5 years, so we do not have to bring that back to year 0. So there's no twist involved. That would be the $1,548,320. Now in years 6 through 15, we'll do the same thing. We'll present value it for this time frame, but then we'll have to bring it back 5 years to the present. So the amount's going to be that 528, which is the 476 and the 52. And then the annuity, if we see the annuity calculation, it's going to give us this $2,754,109. That calculation is the present value of the 14%, comma, 10 periods. 10 periods because 10 periods 6 through 15. And then comma, the payment's going to be that $528,000 to give us the $2,754,109. Now that one then we have to bring back to the present value because this is now 5 years out. So this then is a present value of 1 calculation. We'd have to bring back to period 0 using this formula, present value of 1 calculation, which would be the rate 14%, comma, number of periods 5, because we're bringing it back 5 periods to get it, and then comma, comma, because it's not an annuity this time, present value of 1, and then the future value would be that $2,754,109 to get us to the $1,430,398. Same thing for the last one. We got years 16 through 27. The amounts 505 plus 73 is 578,000. The annuity then being the 327,1649 calculation is going to be the present value of the rate 14%, comma 12 periods because it's going from 16 to 27 years. So 12 periods, comma the payment, that $578,000 we expect to be receiving for those 12 years. So that would be the annuity then, but then we got to bring it back all the way back 15 years back to period 0 with a present value of 1 calculation. That would look like this. Present value of the rate 14%, comma number of periods is going to be 15. We got to bring it back 15 years to get it back to period 0. And then comma, comma, because it's not an annuity, but present value of 1, future value then being the $3,271,649 to get us to the $458,346. And then if we total this up, then we get our total here of the $3,437,064. Now, if we compare that to what we got up top, just so you can kind of match this up, we can say, okay, let's pull out the trusty calculator. Plus the calculator's like action. The calculator's going to get some action here. So we're going to just add these up. 395,614 plus 347,030 plus 304,412 plus 267,028 plus 234,235. And that then, does that tie out to what we got here in the first one? Yeah, that's going to be the 1,548,319 about rounding involved. And then let's do the next one. We're going to say, all right, and then it went from this 528 all the way down to this last one, 15 years. So we're going to pick this number up, the 240550 plus the 211009 plus the 185095 plus the 162364 plus 142425 plus 124934 plus the 109591 plus the 96133 plus the 84327 plus 73971. All right, I think that's it. Okay, let's bring it on down. Did I do that correctly? I totally did it correctly. I wasn't worried. 1,430,399 about. And let's do the last one. See if that one ties out. So see if we can do that one. That's going to be from 16 on down to the end. 16 till the end. So let's bring that down a bit. So can I do that without losing it? All right. 71031 plus the 62308 plus the 54656 plus the 47944 plus 42056 plus the 36891 plus 32361 plus 28387 plus 24901 plus 21843 plus 19160 plus 16807. Whew. And if we scroll on down, that's going to be the 458346 about. Spectacular calculation work. Good work, calculator. That was well calculated. Okay, so then if we compare that, we're going to say then that's going to be the inflow that we have, the 3,437,64. We're going to compare that to the outflow, which we don't need to do anything special to because it's just the outflow at period 0, so it's kind of boring. So that's the outflow, 3,450,000. And that means that the outflow is greater than the inflow, so we have a negative number with our net present value calculation, which means that we didn't clear the 14% capital rate of return or the hurdle rate. And if that's the rate that we want to clear, then we wouldn't accept it at that point. Remember that if it was 0, that wouldn't mean that we got a zero profit, or if we got a $1 positive number, that wouldn't mean we only earned $1. It would, in fact, mean that we cleared the 14% rate of return and therefore may be good, may be accepted, even though it's just $1, right? Because this is not the interest rate here. This includes our cost of capital and includes the rate of return that we would want to receive possibly in order to accept a project or, in this case, the acquisition.